Alright, let's talk about why we need to create the SFO. Securities and Futures Ordinance. We have mentioned the birth of the SFO in the first chapter, so you might have some memories of it. Before the SFO appeared, Hong Kong had some laws to regulate the securities market. However, because of the expansion of new financial products and services and enhanced global competition, there were many new market participants and trading methods, making the securities and futures industry increasingly complex. Therefore, the legal system at the time could no longer meet the demands. Do you remember when we said the reform took place? It was the 1987 stock market crash that prompted the government to create the SFO. Now, Hong Kong's capital market, or what we call the financial market, has become the center of several regions. First, Hong Kong is an important overseas fundraising center for mainland China, which means Chinese companies borrow money from overseas through Hong Kong. Although Hong Kong is not the only one, it still has considerable importance. In addition, Hong Kong is also a regional financial center in the Asia-Pacific time zone, as well as an international financial market straddling London and New York. On the one hand, there are some shortcomings in the existing legal system, and on the other hand, as Hong Kong has become an important financial center, a more efficient, modern, and flexible regulatory regime is needed. Therefore, the SFO was formulated to meet these needs. What are the objectives of the SFO? Do you remember what the first chapter said about the objectives? That is, it's okay if we don't achieve them, but we should work towards these goals. The first objective is to promote a fair, orderly, and transparent market. Second, the SFO should be flexible enough to cope with new products and other innovations, and support further advances in technological infrastructure. Third, the execution of the SFO should be the responsibility of a regulator with sufficient powers and discretion. As mentioned earlier in the first chapter, do you remember which is the main regulatory body? That would be the SFC, Securities and Futures Commission. The SFC operates with high transparency and should have adequate checks and balances to be accountable to stakeholders. That is, the power held by the SFC is not unlimited. There must be adequate checks and balances to limit its power. Fourth, the SFO should meet international standards. We often say that we need to align with international standards. However, while aligning with international standards, we must also meet local needs and circumstances. Alright, so in the first chapter, we mentioned these three roles: licensed corporation, registered institution, and intermediary. Let's review what they are. What is a licensed corporation? A licensed corporation is a non-bank entity that is licensed and directly regulated by the SFC, Securities and Futures Commission, and engages in securities and futures business, such as golden-rich securities. What is a registered institution? A registered institution is an institution supervised by the HKMA, Hong Kong Monetary Authority. They are mostly banks. So again, who regulates banks? They are supervised by the HKMA. Since banks also engage in securities and futures business, they are registered with the SFC, but the main regulatory body is the HKMA. What do intermediaries refer to? Intermediaries generally refer to those engaged in securities and futures business. Both licensed corporations and registered institutions engage in securities and futures business, so both types of institutions are considered intermediaries. So, as mentioned in the first chapter, exchange company, clearing house, exchange controller, investor compensation company, and automated trading services, ATS? I believe everyone remembers them very clearly. Let's test you all now. What exactly is the HKEX that we usually talk about, an exchange company or an exchange controller? HKEX is an exchange controller, meaning a company that controls an exchange or clearing house. So, where do actual trades take place? It's the Stock Exchange of Hong Kong Limited, SEC, and the Hong Kong Futures Exchange Limited, HKFE, which specifically operates securities or futures markets, where people can actually trade. After the trade, who should handle the settlement? The clearinghouse will handle clearing and provide settlement services. There are 4 clearing houses, including the Hong Kong Securities Clearing Company Limited, the SEC Options Clearing House Limited, the HKSI Clearing Corporation Limited, and the OTC Clearing Hong Kong Limited. Remember, the clearing houses handle settlements, and the exchange companies handle trades. As for the Investor Compensation Company, it is actually a wholly owned subsidiary of the SFC, Securities and Futures Commission, mainly responsible for compensating investors. If investors suffer losses due to improper conduct by intermediaries, such as investment brokers violating SFC rules, they can claim compensation from this Investor Compensation Company. Who are the intermediaries? Registered institutions and licensed corporations are intermediaries. Who approves and regulates these operators? It's all done by the SFC, Securities and Futures Commission. Before the SFC issues approvals, it must consult or seek the permission of the Financial Secretary. Additionally, the SFC must ensure that these institutions operate according to the SFO, Securities and Futures Ordinance, and fulfill their functions. Regarding over-the-counter, OTC, derivatives transactions, to provide greater transparency and to allow regulators to better monitor risks in the financial system, Hong Kong established a regulatory framework in 2015. This framework outlines the reporting, clearing, and trading of specified types of OTC derivatives transactions, as well as the penalties for breaching an applicable obligation. So, who is responsible for setting the rules for the above-mentioned obligations? It is the SFC, Securities and Futures Commission. The Hong Kong Monetary Authority, HKMA, serves as the designated trade repository, meaning that institutions need to submit the reported data to the HKMA, which will store the information. So, what other matters require the approval of the SFC, Securities and Futures Commission? For example, if we want to raise funds from the public and to make an offer of investments to the public, such as prospectuses, these plans require the approval of the SFC. The funds and various types of investment products we usually buy must be approved by the SFC before they can be sold to the public. If the sale of products to the public requires SFC approval, what about advertising? That's necessary too. The SFC needs to approve your advertisements and promotional materials. In addition, individuals who operate regulated activities, that is, those who handle securities and futures transactions on behalf of others and have business relationships, are called regulated activities. Who would engage in such activities? For example, securities firm employees and bank sales staff need to obtain licenses or register with the SFC. Remember, the SFC encourages good investment products and eliminates bad ones, so the SFC's approval is necessary. This is similar to what we mentioned in the first chapter, which we call the merit-based approach. Moreover, the SFC acts towards its goals, establishing an appropriate regulatory environment for investment products and encouraging the industry to develop high-quality and well-rounded investment products. In this part, we mainly talk about OFCs, open-ended fund companies. In the past, Hong Kong funds were mainly established as trusts, but since July 2018, with the establishment of some new regulations under the Securities and Futures Ordinance, investment funds can be set up as companies in Hong Kong. As for what an open-ended fund company is, it is actually a type of collective investment scheme, with the primary goal of serving as an investment vehicle to manage investments for the benefit of its shareholders. Here, let's additionally discuss its advantages, so that we can understand the benefits of this type of OFC. It won't be tested in exams, but it's good to know. First, tax exemption. Generally, corporate investment profits need to pay profit tax, but open-ended fund companies don't need to conduct business operations and only serve as a form of investment gambling. Following the China leader Xia Baolong's words, keep trading stocks and keep dancing. Since they purely serve as investment vehicles and are just funds, OFC don't need to pay tax. Second, adding or reducing shareholders does not require a special resolution. As we mentioned before, general companies need to hold a meeting and make special resolutions to change equity, but OFC don't have this restriction. Third, you only need to find an approved Hong Kong auditor to perform the audit work. In the past, funds were established as trusts. Because it was a legal arrangement, it was necessary to find qualified trust lawyers for certification, but now, open-ended funds don't need that. Finding an approved auditor to perform the audit is enough. The SFO, Securities and Futures Ordinance, regulates OFCs, open-ended fund companies, in various categories. So what does it include? First of all, the law prohibits illegal operations. OFCs need to be registered with the SFC, Securities and Futures Commission. If you bypass the SFC and operate as an OFC on your own, it is an offense and may result in fines or even imprisonment. In addition, the law clearly stipulates the establishment, naming, and registration of OFCs. Moreover, there are explicit provisions on how OFCs should issue and redeem shares, pricing, administrative and operational matters, and the roles of different stakeholders such as directors, investment managers, custodians, and auditors. Lastly, the law specifies the compliance obligations of OFCs, such as making appropriate disclosures to investors. We will discuss OFC rules in more detail in Chapter 4. So, the SFC, Securities and Futures Commission, has regulatory authority over OFCs, open-ended fund companies, which includes: the SFC has the power to register OFCs and to cancel their registration. The SFC can also give directions to OFCs and their relevant parties, such as potentially issuing directives to stop the issuance, redemption, or transfer of shares. Under what circumstances would such directives be issued? If the company no longer complies with registration requirements, violates the SFO, Securities and Futures Ordinance, or provides false information to the SFC, etc. The SFC also has the power to cancel any registration on application by the OFC. The SFC has the authority to establish corresponding subsidiary legislation, issue codes and guidelines, such as the OFC rules and the Code on OFCs, which we will discuss in more depth in Chapters 4 and 5. Our special administrative region government always talks about it. The goal of Hong Kong is to attract businesses and talents. To attract more companies to register in Hong Kong and develop Hong Kong as the preferred fund registration location, the Hong Kong government introduced the redomiciliation mechanism for overseas corporate fund companies. The Code on Open-Ended Fund Companies, amended on September 11, 2020, includes the introduction of a statutory mechanism for overseas corporate funds to redomicile to Hong Kong, the Securities and Futures Amendment, Ordinance 2021, which officially came into effect on November 1, 2021, also stipulates that overseas OFCs, open-ended fund companies that meet the relevant qualification requirements for registering new funds in Hong Kong can redomicile to Hong Kong and register as OFCs in Hong Kong. So what does redomiciliation mean? Redomiciliation refers to a company canceling its original registration location and re-registering in another jurisdiction. Simply put, it means moving from one place to another. So let me ask you, is an open-ended fund company an intermediary or an investment vehicle? Remember, it is an investment tool. Funds outside Hong Kong, if established in the form of a company and meeting the relevant requirements for registering new funds in Hong Kong, can apply to the SFC to register as an open-ended fund company. Once approved, the fund company can transfer its funds registered in other countries to Hong Kong. For example, I have a fund company registered in the UK. Now I think Hong Kong is great, with many talents and tax benefits, so I want to move there to operate. If I meet the relevant qualification requirements, I can carry out the redomiciliation action, apply to the SFC to become an open-ended fund company, and apply for a redomiciliation certificate, redomiciliation form, from the company's registry. Then I can move the registration location from the UK to Hong Kong. Just like all newly established open-ended fund companies in Hong Kong, they have the same rights and bear the same responsibilities. What are the benefits of fund redomiciliation? Under this redomiciliation system, the legal identity of open-ended fund companies remains unchanged, so their existing contract arrangements, resolutions, and legal liabilities will not be affected. What does this mean? If I have a fund company in the UK, I originally issued the fund according to UK law and signed various contracts with clients. But now, I want to move to Hong Kong to operate. If there is no simple redomiciliation system, I might have to redeem or subscribe to the issued funds again, sell the assets in the original fund, and turn them into cash. The whole process would be cumbersome and require a lot of procedures. It's like when you want to immigrate, you may have to sell your furniture at home and turn it into cash. Now you don't have to, you can directly move the furniture over. Is the redomiciliation system provided by the Hong Kong government flexible and feasible in reality? Not necessarily. In addition to meeting all the requirements of newly established OFCs, the redomiciliation of overseas corporate funds is also subject to various documentary and procedural requirements, such as proof of incorporation in the overseas jurisdiction. Furthermore, the Articles of Association of Overseas Fund Companies or the laws of their original registration locations may impose restrictions on redomiciliation, making it impossible to complete the redomiciliation. Just as I welcome all wealthy women, rich women, and beautiful women, whether you are willing to marry me is another story. So, which activities fall under the regulation of the SFC, Securities and Futures Commission? There are a total of 10 regulated activities in the securities and futures industry. Remember, exams sometimes test these 10 types of activities, and the main thing is to remember their names and numbers. How can we remember these activities? First, remember that 1 and 4 are securities, and 2 and 5 are futures contracts. What does that mean? 1 and 4 are activities related to securities. The first type is dealing in securities, which means acting as an intermediary to buy and sell stocks for clients. The fourth type is advising on securities, which means providing paid advice on buying and selling stocks to clients. 2 and 5 are futures contracts that refer to activities related to futures contracts. The second type is dealing in futures contracts, which means acting as an intermediary to buy and sell futures for clients. The fifth type is advising on futures contracts, which means providing paid advice on buying and selling futures to clients. The third type is leveraged foreign exchange trading, which is also related to trading. The sixth type is advising on corporate finance, such as when a company is preparing for an IPO, we provide advice on the listing process or mergers and acquisitions. The seventh type is providing automated trading services. The eighth type is securities margin financing, which simply means operating as a pawnshop for stocks. People bring their stocks to the company as collateral, and then you provide them with a loan. This is called securities margin financing and falls under the eighth type of business. The ninth type is asset management, which involves managing securities and futures for clients or managing collective investment schemes. Finally, the 10th type is providing credit rating services, which involves receiving client fees and providing a neutral and independent assessment of their credit situation. For example, you often see S&P Global Ratings and Moody's Ratings providing credit rating services. Let me remind you again that you only need to remember the activity names and numbers. Also, engaging in regulated activities requires a license or registration, and engaging in these activities without proper approval is illegal. So what is a single licensing system? A single licensing system refers to the SFC's licensing or registration, where you will be given only one license number, and one license number can be used for multiple types of activities. For example, if I have now passed the relevant exams, I can engage in both Type 1 and Type 4 activities, and the license issued to me by the SFC will indicate both Type 1 and Type 4. If you have a driver's license, it is easy to understand. So the SFC has issued me a license to engage in types 1 and 4 activities. Can I also do types 2 and 5 activities? Generally speaking, you cannot. You need to pass the relevant tests for types 2 and 5 and have types 2 and 5 registered before you can do so. That is, if I want to engage in types 2 and 5 activities, I need to pass the corresponding tests and obtain the SFC's approval. At this time, the license number remains the same, but types 2 and 5 are additionally registered on the license. Then you can engage in types 2 and 5 activities. So remember, the license number is permanent, and one person can have one license and engage in more than one type of regulated activity. There are a total of 10 types of regulated activities, and how many types of activities a single license can cover depends on how many tests you pass. This is called single license regime. So, who may be licensed or registered? Intermediaries need to obtain a license or register. Remember, only legal entities, or companies, can become intermediaries. As mentioned before, a licensed legal entity is called a licensed corporation. If the licensed corporation is an authorized financial institution, it is called a registered institution. Both licensed corporations and registered institutions are considered intermediaries. So again, who may be licensed or registered? There is a role called a representative. What is a representative? A representative must be a natural person who represents an intermediary in carrying out regulated activities. Similarly, since they engage in regulated activities, representatives also need to obtain a license or register. So, pay attention, whether it's an intermediary, representative, or responsible officer, before becoming a licensed or registered person, they need to meet a requirement called fit and proper. Who decides whether you are fit and proper? It is determined by the SFC, Securities and Futures Commission, because the SFO, Securities and Futures Ordinance, states that the SFC has the power to decide, and it will consider the candidate's qualifications, experience, etc. You must meet this fit and proper requirement to become an intermediary, representative, or responsible officer. Please note that, whether it's intermediaries, representatives, or responsible officers, before becoming a licensed or registered person, they need to pass a test called fit and proper. Who decides whether you are fit and proper? The SFC, Securities and Futures Commission, makes the decision, as the SFO, Securities and Futures Ordinance states that the SFC has the authority to determine this. They will consider qualifications, experience, and other factors. You must satisfy fitness and properness requirements to become an intermediary, representative, or responsible officer. Do you remember what was mentioned in the first chapter? The SFO, Securities and Futures Ordinance, grants the SFC, Securities and Futures Commission power to establish subsidiary legislation. The SFC handles the details regarding subsidiary legislation of the SFO. What does this include? It includes creating subsidiary legislation to regulate intermediary activities, such as establishing rules for handling financial resources, setting rules for handling client money and other client assets, rules for keeping accounts and records, and rules for auditing matters. Why does the SFC establish these rules? It aims to improve the standards of intermediaries, increase transparency, and manage intermediaries more effectively to protect investors. You will notice that the SFC is working towards its goals and duties. Let's talk about one of the common provisions, which is the FRR, Financial Resources Rules. So, what is the FRR about? These rules specify that the licensed corporation needs to maintain a certain amount of capital. You must reach a certain financial level, meaning you must have enough money to keep your license. In addition, the rules also clarify other matters related to financial resources, such as when to submit statements and when to notify the SFC, Securities and Futures Commission, about whether they meet the requirements. Rules are established so that licensed corporations can comply. At this point, you might be wondering why they don't restrict registered institutions. Well, do you remember what registered institutions are? Registered institutions are banks or other licensed institutions under the HKMA, Hong Kong Monetary Authority. They are licensed by the HKMA, not the SFC. The HKMA itself also has relevant FRR. To avoid confusion, registered institutions follow the rules set by the HKMA, and the FRR set by the SFC only applies to licensed corporations. If a licensed corporation cannot comply with the FRR, financial resources rules, and cannot maintain the specified amount of funds, what should they do? For example, there is now a licensed corporation, and the SFC, Securities and Futures Commission, requires them to maintain a level of 5 million Hong Kong dollars, but it is found that the company's funds are insufficient to maintain this amount. What should be done? The first thing to do is for the company to notify the SFC in writing as soon as reasonably practicable. So, can they just verbally tell the SFC that they don't have enough money? No, they must notify in written form, which means it must be clear and in black and white. The second thing to do is to immediately cease carrying on any regulated activity. For example, if I am currently engaged in Type 1, 4, 6, and 9 regulated activities, but my funds are insufficient, can I only do Type 1 and 4 and not do Type 6 and 9 regulated activities? No, they must stop all of them. The FRR also has other requirements. If the licensed corporation fails to comply, such as forgetting to submit a report, they can notify the SFC in writing within 1 business day. Remember, if there is insufficient funds, they must immediately notify the SFC in writing and immediately stop all regulated activities. If they violate other FRR requirements, such as forgetting to submit a report, then notify the SFC within 1 business day. If the SFC, Securities and Futures Commission, reasonably believes that a licensed corporation cannot comply with the specified capital requirements, it may by notice in writing suspend the corporation's license, or under certain specific circumstances, impose additional conditions on them. The licensed corporation must satisfy these additional conditions for the SFC to allow them to operate. For example, the SFC may require you to report daily how much money the company has. If you meet the SFC's additional requirements, they will let you continue to operate. In short, as long as the SFC approves, even if a licensed corporation cannot meet the requirements of the FRR, financial resources rules, they can still continue to operate. If a licensed corporation encounters the following situations, it is already considered a crime. First, fails to comply with certain of the SFC, Securities and Futures Commission's financial resources requirements, including breaching any condition imposed by the SFC. What does this mean? Suppose you are a licensed corporation and know that the company's funds are insufficient. You take the initiative to notify the SFC, and then the SFC allows you to continue to operate, but imposes additional conditions. However, you did not comply. In this case, it is also considered an offense. Second, continues to trade while in breach of the FRR without the SFC's permission. As we have mentioned, when a licensed corporation finds that it no longer complies with the financial resources requirements, it must not only notify the SFC as soon as possible but also immediately cease regulated activities. If the SFC does not approve and you still continue to engage in regulated activities, it is an offense. So how does the SFC, Securities and Futures Commission, monitor whether licensed corporations comply with the FRR? Financial resources rules. The SFC can investigate licensed corporations, including requiring them to demonstrate its compliance with the FRR at any time, such as by submitting reports. Alternatively, the SFC can authorize certain individuals to conduct audits, for example, by sending someone in person to the licensed corporation to verify whether they are indeed following the regulations. If the licensed corporation fails to prove its compliance with the regulations, as mentioned earlier, the SFC can temporarily suspend the license or establish certain specified conditions requiring them to operate under these conditions. Any breach of these conditions is considered an offense. Under the SFO, Securities and Futures Ordinance, there is another subsidiary legislation called the Client Securities Rules. What are client securities? It refers to when a client places their securities and collateral with an intermediary who holds and handles them. We call these client securities. If the client withdraws an IPO, fills in the white form, and keeps it themselves, those are not considered client securities. What are the Client Securities Rules? These are rules established by the SFC, Securities and Futures Commission, regulating the handling of client securities activities by intermediaries. Similarly, the Client Securities Rules are subsidiary legislation. A breach of the rules will be an offense. So, who do the Client Securities Rules apply to? Who needs to comply with them? These rules apply to intermediaries, that is, licensed corporations and registered institutions. Both must comply with these rules. Additionally, there is a rule called the Client Money Rule. What is client money? It is very similar to client securities. It refers to when a client places their money with an intermediary, and the intermediary holds and handles the client's money. For example, when we buy stocks, we would personally write a check to the securities firm. That check must reach the hands of the licensed corporation before it is considered client money, otherwise, it doesn't count. So, what is the Client Money Rule? It is a rule established by the SFC, Securities and Futures Commission, that regulates the activities of licensed corporations and their associated entities holding of and dealing with client money. The Client Money Rule is one of the subsidiary legislations. A breach of the rules will be an offense. Who is the Client Money Rule applicable to? It only applies to licensed corporations and their associated entities. So, do registered institutions need to comply with this regulation? No, they don't. Why don't registered institutions need to? Because registered institutions are banks, and banks follow the guidelines of the HKMA, Hong Kong Monetary Authority, so they don't need to comply with this rule to avoid confusion. What is an associated entity? An entity can be seen as a company, even if it is registered overseas, but the company has a place of business in Hong Kong, so this type of company is also included. An associated entity refers to a company that has a controlling entity relationship with an intermediary. If it holds the shares of the intermediary, it is considered an associated entity. In simple terms, it means that the company and the intermediary, which is a licensed corporation or registered institution, belong to the same group of companies. For example, if you open a securities firm and I am the parent company of that securities firm, the parent company would be your associated entity. Moreover, if this company in Hong Kong receives or holds the client assets of the intermediary, such as when a client deposits money into the securities firm, and I, as the parent company, help the securities firm to keep that money, then we are considered an associated entity. So, what is a controlling entity? As mentioned earlier, we can consider an entity to be a company if this company holds no less than 20% of the voting power in a corporation, or it has the right to nominate any directors of the corporation. In other words, it has the power to control who becomes a director of the corporation. It can already be called a controlling entity. In addition, if the company has influence over the corporation, such as having an interest in shares which entitles the person to veto or amend resolutions, it is also considered a controlling entity. What responsibilities do associated entities have? Do you remember what associated entities do? They help intermediaries hold client assets. Suppose we are an associated entity of a licensed corporation, and for some reason, we don't want to continue, such as selling it to someone else. In that case, we must notify the SFC, Securities and Futures Commission, in writing within 7 business days. Similarly, if there are any changes in our information, we must also advise the SFC within 7 business days. In addition, there is a crucial provision: apart from the businesses approved in writing by the SFC, associated entities of intermediaries are not allowed to conduct any other business. In other words, without SFC approval, they can only help intermediaries hold client assets and cannot engage in other businesses. Be aware of this. This provision does not apply to authorized financial institutions, which are registered institutions. Why don't registered institutions need to comply? Because registered institutions are already engaged in banking businesses, they will undoubtedly exceed this scope, so they can be exempted. Similarly, if an associated entity contravenes any matters mentioned above, it commits an offense. In the SFO, Securities and Futures Ordinance, there is a subsidiary legislation called the Keeping of Records Rules. The Keeping of Records Rules apply to all intermediaries, including licensed corporations and registered institutions. This legislation also applies to associated entities, in other words, companies that help intermediaries hold client assets. What does this legislation regulate? It mainly governs document archiving, specifying what documents you need to keep, how long the documents need to be kept, and so on. What happens if you violate the Keeping of Records rules? It is an offense. How can it be considered an offense? If the SFC, Securities and Futures Commission, requires you to keep documents, you should keep them properly. If you intentionally keep false or misleading records, you have already violated the Keeping of Records rules. If you knowingly have the record, but you intentionally destroy it or fail to maintain the record, you are also in violation of the Keeping of Records rules. In terms of record keeping, the SFO, Securities and Futures Ordinance, has another subsidiary legislation called the Contract Notes, Statements of Account and Receipts rules. These rules apply to all intermediaries, including licensed institutions, registered institutions, and associated entities of intermediaries. What does the Contract Notes, Statements of Account and Receipts rules regulate? As you may have guessed from the name, it mainly governs how intermediaries and their associated entities prepare statements of account and receipts, such as when a statement should be sent to a client, when a confirmation should be provided to the client to confirm what has been received, when the transaction was executed, and how the transaction was carried out, or what details need to be included. Therefore, this regulation mainly establishes when and how intermediaries should issue monthly statements or proofs to their clients. The Securities and Futures Ordinance establishes provisions related to accounting and auditing, including the Accounts and Audit Rules, which primarily govern the accounting and auditing of licensed corporations. Operating a business involves a lot of accounting, and the SFC, Securities and Futures Commission, wants to know the details of these accounts, as they can prove the financial status of your company, the status of your clients, and whether your business is sound or not. Who are the Accounts and Audit Rules applicable to? Remember, these rules do not apply to registered institutions. That is, banks engaged in securities and futures businesses do not need to comply with these rules. Why? As you may know, there are relevant regulations from the HKMA, Hong Kong Monetary Authority. Simply put, this provision only applies to licensed corporations and their associated entities. What does the Accounts and Audit Rules stipulate? It requires that the audited accounts of licensed corporations must be submitted to the SFC not later than 4 months after the end of the financial year. If a licensed corporation ceases operations, audited accounts must be submitted to the SFC not later than 4 months after the date of cessation of the business. Failure to submit these documents as required is an offense. With audits, naturally, there is a need for auditors. The SFO, Securities and Futures Ordinance, clearly outlines the regulations for appointing auditors. If a licensed corporation and its associated entity are granted a license, they must find an auditor within 1 month. After appointing the auditor, they must notify the SFC, Securities and Futures Commission, in writing within 7 business days. Failure to appoint auditors is an offense. When a licensed corporation or associated entity appoints an auditor, they must notify the SFC, Securities and Futures Commission, within 7 business days. So, it gives notice of a resolution to remove or to replace an auditor. When should they notify the SFC? When a licensed corporation or associated entity issues a notice of resolution to dismiss or no longer remove or to replace an auditor, they must notify the SFC in writing within 1 business day. Even if the auditor voluntarily leaves, they still need to provide a written notice to the SFC within 1 business day. In addition to auditing corporations, auditors also have several responsibilities, such as monitoring corporations or associated entities to ensure they comply with regulations. When auditors discover abnormal situations or noncompliance, such as a licensed corporation violating the SFC, Securities and Futures Commission's rules, breaching subsidiary legislation, violating legislation, or encountering serious financial problems, auditors need to promptly submit a written report to the SFC. If the auditor is auditing a registered institution and discovers something unusual, to whom should they report? In this case, the auditor should report to the HKMA, Hong Kong Monetary Authority, not the SFC. Why? Because the HKMA is the regulatory authority for registered institutions. As mentioned earlier, if an auditor resigns voluntarily, meaning they choose to leave rather than being fired, they need to notify the SFC, Securities and Futures Commission, in writing, reporting several things. These include explaining to the SFC why they are no longer serving as an auditor and whether there are any special circumstances involving the corporation that the SFC should be aware of. If the auditor discovers that the company is engaging in fraudulent accounting, money laundering, or violations, and reports it truthfully to the SFC, they are fulfilling their responsibilities as an auditor. On the other hand, if they are aware of these issues but do not report them, it is considered a dereliction of duty, and they may face legal consequences. Why? Because the duty of an auditor is to investigate whether a company is engaged in any wrongdoing or illegal activities, so failing to report known issues is considered a breach of duty. The SFC, Securities and Futures Commission, also has the power to appoint a special auditor to investigate the accounts of licensed corporations and their associated entities. Under what circumstances would the SFC take such action? This includes, the SFC believes that the licensed corporation has not complied with the FRR, Financial Resources Rules, or the licensed corporation or its connected entities have not complied with the SFC's regulations and have not submitted audited accounts and reports. Another situation is when the SFC receives a special auditor's report. In other words, when the auditor discovers anomalies and issues a written notice to the SFC, which has been mentioned before. If you find that a licensed corporation or an associated entity has some serious issues, you can actually report it to the SFC, Securities and Futures Commission. How do you report it? By submitting a written application to the SFC. After the SFC receives your application, they will consider the reasons for your report and whether it's a good reason, and then decide whether to appoint an auditor to review the suspicious licensed corporations and associated entities. So, what constitutes a serious event? These include: the first situation is when a licensed corporation takes the client's assets but refuses to explain the whereabouts of the assets or funds to the client. Simply put, if I am a stockbroker and you are my client, you put your money in my pocket, but I don't tell you where the money has gone or what it has been used for. As a client, you have the right to know the whereabouts of your assets or funds. In this case, you can submit a written application to the SFC and ask them to investigate the stockbroker. The second situation is when the licensed corporation does not act according to the client's instructions and does not compensate the client for the profits or losses they are entitled to. Suppose you place an order with a stockbroker, saying that you want to sell when the price reaches $3, but the stockbroker doesn't listen to you and sells at $2.50 instead. Because the stockbroker didn't follow your instructions, you lose the profits you were supposed to get, and they don't provide an explanation. In this case, you can submit a written application to the SFC and ask them to investigate. So, what powers does the auditor appointed by the SFC have? Basically, the auditor appointed by the SFC has many powers, similar to those of an investigator. This auditor can question relevant persons of the licensed corporation, including officers, employees, agents, and other auditors, requesting them to provide evidence and even conduct face-to-face interviews to collect statements. In addition, the auditor can also request records from recognized exchange companies, clearinghouses, and any representatives related to holding client assets. The powers of the auditor appointed by the SFC are limited to the audit work, and matters outside the audit are not related to them. However, a person who, without reasonable excuse, fails to comply with any requirement so imposed on him will be guilty of an offense. If you are a licensed corporation currently undergoing an audit and being investigated, and it turns out that you have indeed done some wrongdoings, you start to feel guilty and uneasy, so you want to find a way to interfere with the audit to prevent your illegal activities from being exposed. Is this considered an offense? Indeed. Why? Because you may deliberately create false records, attempt to destroy or hide records, and thus fail to provide accurate records. If you say you are not the mastermind, but just helping others, it is still an offense. Secondly, knowing that an audit is in progress, you intentionally move assets, delay, or interfere with the audit, which is also illegal. In addition, if you leave or attempt to leave Hong Kong, making it impossible for the SFC's auditors or investigators to find you, this is also an offense. This table summarizes several important subsidiary legislations under the Securities and Futures Ordinance. Do you remember who established these subsidiary legislations? It is the SFC. After the SFC establishes these subsidiary legislations, do the licensed corporations under its jurisdiction, i.e., the licensed corporations regulated by the SFC, have to comply with them? Of course, they must comply, but don't forget that registered institutions also need to comply with some of the subsidiary legislations established by the SFC. So, I want to ask, are these financial resources rules, client securities rules, client money rules, keeping of records rules, contract notes, statements of account and receipts rules, and accounts and audit rules considered laws? These rules, remember that they are all subsidiary legislations. If you violate these subsidiary legislations, it is equivalent to breaking the law, and there is a chance of imprisonment, right? It's not guaranteed imprisonment, but there is a possibility. Here's another tip for you: look at this table and anything related to money, including what? Financial resources rules, client money rules, and accounting and auditing rules. These rules involving money, registered institutions do not need to comply. Why? Because registered institutions, in other words, banks, have to listen to whom? That would be the HKMA, Hong Kong Monetary Authority, so they must comply with the relevant regulations and guidelines of the HKMA. So let's talk about codes of business conduct. Well, the SFC, Securities and Futures Commission, often issues guidelines or codes of conduct to achieve their regulatory objectives. These codes of business conduct or guidelines are not laws. I repeat, the codes of business conduct issued by the SFC are not laws. So, since they are not laws, if you violate these codes of business conduct, you will not be breaking the law. However, does this mean there will be no consequences? What kind of impact could it have? Because you violated these codes of conduct, you may not be considered as a fit and proper person to remain licensed or registered by the SFC. And the SFC might even permanently prohibit you from engaging in this industry. You might say, "If I can't make it here, I'll try elsewhere." But if you commit other offenses in the future, a record of violating professional conduct could be a disadvantage and affect the judgment. But remember, codes of conduct are not laws, so if you violate them, you are not breaking the law. Therefore, will violating codes of conduct lead to imprisonment? You will never be imprisoned for that. Remember, as an intermediary, even if you have obtained a license, you cannot tell people that you are recommended or specially guaranteed by the SFC, Securities and Futures Commission, or the government, whether explicitly or implicitly, because it is illegal. Now let me test you. If I say, I am a licensed person of the SFC, is this statement illegal? No, because this is a fact and does not mention any recommendation from the SFC. If I say, the Hong Kong government highly recommends licensed persons in 2023, is this statement violating the law? Yes, because it mentions the government's recommendation, which is illegal. If I say, Jackie Chan personally highly recommends the best licensed broker, is this statement violating the law? No, because it is a personal recommendation from Jackie Chan, not a recommendation from the SFC or the government. The SFO, Securities and Futures Ordinance, does not allow short selling. So, what is short selling? Short selling is actually a kind of speculation. When you think the price of a certain stock will drop, you borrow the stock from someone, sell it immediately, and when the stock price falls, you buy back the stock and return it to the person who lent it to you. This way, you can make money from the price difference. However, the SFO prohibits anyone from doing this. You are not allowed to sell stocks to others without having owned them before, and this practice is not allowed. Please note that short selling regulations only apply to the cash market. To repeat, it only applies to the cash market. As for options trading, the SFC, Securities and Futures Commission, has established some rules prohibiting options trading that is not in accordance with these rules. In other words, if you want to trade options, you must follow the rules for options trading set by the SFC. The SFO, Securities and Futures Ordinance, also states that unsolicited calls, that is, cold calls, are not allowed. What are cold calls? For example, I am a stockbroker. I proactively contact you and promote regulated activities, such as buying stocks or securities. These are considered unsolicited calls. Now let me test you. I am a stockbroker. I don't know you, but I call you now and say, I am Chin Yifan. I am a stockbroker. I drive a sports car, and I want to invite you to go hiking and dancing together, to make friends. Is that okay? Is this considered an unsolicited call, that is, a cold call? No, it's not. Why? Because I didn't ask you to buy any products. I am only calling you to make friends and let you know I am a handsome and wealthy stockbroker, but I have never asked you to buy any investment products. Remember, unless the client proactively asks you to sell to them, you cannot actively promote securities and futures, you cannot make unsolicited calls, you cannot call strangers. Of course, if you call them and ask them to buy drinks, tissues, or make friends, then there is no problem. So the SFC, Securities and Futures Commission, has a lot of power. Let's talk about the two main powers of investigation. First, make inquiries and obtain documents and answers from relevant parties. Second, investigating breaches of the SFO, Securities and Futures Ordinance, or misfeasance and activities that are not in the public interest. So, who does the SFC investigate? Anyone. Basically, anyone can be the subject of their investigation. The SFC, Securities and Futures Commission SFC, may carry out an inquiry into a listed company. It has powers to obtain records and documents. If the listed company cannot submit them, the SFC has powers to obtain explanations and statements on oath as to why the information cannot be produced. So, who can they investigate? Anyone. For example, staff of the listed company, from directors to employees, may be subject to inquiries. In addition, those related corporations, AFIs, authorized financial institutions, and auditors. In short, anyone involved may be subject to inquiries. The SFC, Securities and Futures Commission, may carry out an inquiry into related corporations of a listed company. What are related corporations? They are the parent company, subsidiary, and those with a relationship to the listed company. Additionally, the associated companies of listed companies may also be investigated. Why do associated companies need to be investigated? Because they have the same substantial shareholders or management members. Can the SFC, Securities and Futures Commission, investigate intermediaries? Remember, the SFC has the power to investigate anyone, so it can, of course, look into intermediaries and associated entities. The SFC can conduct supervisory inspections to ensure that intermediaries are complying with the requirements and notices of the SFO, Securities and Futures Ordinance, as well as meeting licensing conditions, etc. If other regulatory bodies or foreign governments are investigating licensed corporations, the SFC can provide assistance, including requesting document copies from licensed corporations or even inquiring into their affairs. How does the SFC conduct supervisory inspections on intermediaries? The SFC may authorize a person to inspect the premises of the licensed corporation, as well as request documents and explanations of the situation. Under what circumstances can we refuse to provide documents to the SFC? Remember, in these investigations, registered institutions have a privilege. They do not need to provide documents unrelated to the investigation. As you may recall, registered institutions are banks and authorized financial institutions. Banks hold a lot of client information. Unless the client information is related to the investigation, the bank does not need to provide the data. Remember, the SFC can investigate anyone. When the SFC suspects that a transaction is questionable or problematic, they can, of course, look into the parties involved in the transaction, the beneficiaries of the parties, and the intermediaries participating in the transaction. Essentially, as long as the SFC wants to conduct an investigation, they have the right to request the disclosure of transaction information from the aforementioned individuals, including transaction details and people involved in the transaction. You have a responsibility to assist and cooperate with the SFC's investigation. If you do not have a reasonable reason and refuse to provide the information, it will then constitute an offense. The SFC can appoint certain special individuals, usually SFC employees, to carry out investigations. Once an investigator is appointed, they will represent the SFC in investigating anyone. How can they conduct the investigation? This includes requiring anyone to provide documents and explanations, requesting meetings, etc. As mentioned earlier, the person being investigated has a responsibility to assist the investigator, provide all necessary evidence, and even make a statutory declaration. If you fail to comply with the requests of an investigator, there will be consequences, which may constitute an offense. During the investigation, what situations may constitute an offense? If you intentionally fail to comply with the requests of an investigator appointed by the SFC or provide false or misleading responses, is guilty of an offense. In addition, as long as you are an employee of a legal entity and you know that the entity is committing an offense or even allowing it to commit an offense, that is also against the law. What does it mean by allowing it to commit an offense? You know that your subordinates are breaking the law, but you did not stop their illegal actions, so you are responsible. If you want to interfere with the investigation, attempt to destroy, alter, or hide documents, etc., to delay or mislead the investigation, that is also against the law. If you do not comply with the requests of an investigator, such as when a company suddenly delays and does not accept the investigation, what can the SFC, Securities and Futures Commission, do? In a situation where there is no alternative, the SFC can apply to the court for assistance, seeking the court to force the company to respond. Warrant. When you see this word warrant, you know it's not issued by the SFC, Securities and Futures Commission, SFC, but by the court. Under what circumstances does the court need to issue a warrant? When conducting investigations, the SFC may apply to a magistrate for the issue of a warrant. Remember, the warrant is issued by a magistrate, not by the SFC. The SFC needs to apply for it. What is the function of a warrant? Once the court issues a warrant, it grants powers to the SFC and related parties. For example, investigators can forcefully enter certain premises and have the right to demand any person to hand over documents, as well as prohibit the deletion, alteration, and removal of documents, etc. Basically, with this warrant, the SFC can conduct investigations more easily. Now, let's test your understanding. Who issues the warrant? The warrant is issued by the court and has legal authority, while the SFC only applies for this warrant. The SFC, Securities and Futures Commission, has the authority to enforce disciplinary actions, so how can it punish those involved? First, let's consider whether the SFC is a court. Can the SFC sentence people to prison? Remember, the SFC is not a court, so it can never sentence anyone to imprisonment. If a regulated person is guilty of misconduct, how can the SFC take action? Regulated persons refer to individuals regulated by the SFC, including licensed corporations, licensed representatives, registered institutions, responsible officers, and persons involved in the management of the business. Those involved in business management are not necessarily licensed by the SFC, but they are supervisors responsible for overseeing any misconduct, so they are also considered regulated persons. Misconduct refers to violations of the SFO, Securities and Futures Ordinance, and the CO, Companies Ordinance, as well as breaches of the terms and conditions of any license or registration with the SFC. In addition, if the SFC believes that a regulated person's actions are prejudicial to the public interest while engaging in regulated activities, or if the SFC believes that the person knowingly harms the public interest without taking any action, these are also considered misconduct. When regulated persons engage in misconduct, the SFC can revoke or temporarily suspend their licenses, revoke or suspend approval as a responsible officer, or even prohibit them from reapplying for licenses or registrations in the future. Additionally, the SFC may publicly reprimand the regulated persons involved in misconduct or order them to pay fines. Except for imprisonment, the SFC can basically take any disciplinary actions. If intermediaries have not broken the law, meaning licensed corporations and registered institutions have not engaged in misconduct, can the SFC still temporarily suspend or revoke their licenses? Under certain circumstances, the SFC can temporarily suspend or revoke licenses, including 1. Intermediaries going bankrupt, having their assets taken over, or entering into debt arrangements with creditors, which may result in the intermediaries being unable to continue operating. 2. Intermediaries facing insolvency, being unable to repay debts, and lacking financial capabilities. 3. Directors or responsible officers of intermediaries becoming mentally incapacitated, losing their ability to act. 4. Directors or decision-makers of intermediaries committing crimes, raising questions about their fitness and properness. Usually, these individuals may have committed dishonest or fraudulent offenses, making them unfit and improper. In these 4 situations, the SFC can temporarily suspend or revoke licenses. Be brave, face your mistakes. As an intermediary, if you engage in violations, admitting your mistakes and taking responsibility actually has benefits. Why? Because the SFC, Securities and Futures Commission, will reduce disciplinary sanctions and acknowledge the cooperation of intermediaries. The sooner you report to the SFC, the higher the reduction you may receive in sanctions, up to a maximum of 30%. How can intermediaries cooperate with the SFC? This includes voluntarily and promptly reporting violations or breaches to the SFC, providing truthful and complete information, being willing to bear legal responsibility, and taking corrective measures. For example, if I am an intermediary and find that I have made a mistake, causing losses to a client, I can take the initiative to report the error to the SFC, providing detailed transaction information such as transaction dates, stock codes, etc. By doing this, I can notify the SFC early and allow them to handle the situation more quickly. I actively cooperate with the SFC's investigation, providing whatever documents they need and sharing everything I know. At the same time, I take some remedial measures, such as paying full compensation to the victim and correcting any deficiencies. In short, if an intermediary wants to reduce their sanctions, remember, report, cooperate, accept, and take rectification measures. Oftentimes, the SFC, Securities and Futures Commission, has to intervene in the way licensed corporations operate their business. Remember, the SFC can only intervene in licensed corporations, not in registered institutions. Do you remember who regulates registered institutions? The regulator for registered institutions is the HKMA, Hong Kong Monetary Authority, not the SFC, so the SFC cannot intervene in how registered institutions operate their business. So why does the SFC have to intervene in licensed corporations? The main reason is to protect the interests of investors, minority shareholders, and creditors of licensed corporations. If it can protect the public interest, the SFC will step in and intervene in the operation of licensed corporations. In addition, if a licensed corporation encounters certain issues, such as it does not meet the fit and proper criteria or contravene the specified provisions of the SFO, Securities and Futures Ordinance, or even had its license revoked, the SFC will intervene in the operation of the licensed corporation. How can the SFC, Securities and Futures Commission, intervene in the operation of a licensed corporation? This includes restricting the business activities of a licensed corporation, prohibiting it from carrying out specified activities, or even prohibiting it from disposing of or dealing with property belonging to its clients. To ensure that the licensed corporation has sufficient assets to meet its debts, the SFC may require it to maintain specified value or types of assets in Hong Kong or overseas, such as having a deposit of $1 million, and these assets should be easily transferable or disposable, meaning they must have a certain level of liquidity and be readily available when needed. Remember this, everyone, the power of the SFC, Securities and Futures Commission, is also subject to checks and balances. Before the SFC can intervene, it must issue an intervention notice. Once an intervention notice is issued, if the SFC wants to withdraw, vary, or make substitutions to notices, it must provide reasons. Although the SFC has significant power, there are limitations in place to prevent it from acting arbitrarily and to avoid the abuse of power. However, if the licensee of a licensed corporation does not comply with the notice, the SFC can apply to the court of first instance to order him to comply. If a corporation encounters problems, what can the SFC, Securities and Futures Commission, do? The SFC can apply to the court of first instance, applying for court orders according to relevant ordinance, including winding up orders, requiring the dissolution of the company, bankruptcy orders, requiring the court to liquidate the assets of the licensed representative to repay debts, and injunctions, mandating compliance by any person who violates relevant provisions, orders, or notices, or breaches any licensing conditions. The SFC can apply for a winding up order from the court based on the QMPO. Companies, Winding Up and Miscellaneous Provisions, Ordinance. However, please note that this winding up order does not apply to AFIs, Authorized Financial Institutions, and OFCs, Open-Ended Fund Companies. The SFC needs to apply for the liquidation of OFCs according to the OFC rules. Please note that applying for a winding up order must be based on just and equitable grounds. Additionally, to protect the public interest, the SFC can also apply for bankruptcy orders for licensed representatives according to the Bankruptcy Ordinance. Finally, there are injunctions, which apply to anyone who violates the SFO, Securities and Futures Ordinance, or breaches any licensing conditions, orders, or notices. This includes the aforementioned intervention notices. If the licensed corporation does not comply with the intervention notice issued by the SFC can apply for an injunction to enforce relevant laws and regulations. Oftentimes, listed corporations, or OFCs, open-ended fund companies, may defraud shareholders, members, or use inappropriate methods to deceive small shareholders, causing unfair damage. For corporations, the SFC, Securities and Futures Commission, can apply to the court of first instance for various orders to sanction the company through legal means. However, if the listed corporation is an AFI, authorized financial institution, before the SFC applies to the court for orders, it needs to consult with the HKMA, Hong Kong Monetary Authority, and seek their opinions. Is this world fair? You might feel that the Securities and Futures Commission, SFC, has some issues, and its decisions are unfair to you, as if they are always targeting you. In that case, you can appeal to the SFAT, Securities and Futures Appeals Tribunal, to review the decisions or regulations made by the SFC. The SFAT is chaired by a judge, who will examine the decisions made by the SFC or the HKMA, Hong Kong Monetary Authority, conduct hearings, and ensure that their regulation is fair and reasonable. Remember, there is an investor compensation fund in Hong Kong. What is an investor compensation fund? It is established by the SFC, Securities and Futures Commission. Its main purpose is to compensate the investment losses suffered by the clients of intermediaries, in other words, investors. Remember, these investment losses are based on the intermediaries defaulting on its obligations. Defaulting on its obligations refers to the intermediary or their employees or associates being insolvent, bankrupt, or liquidated, or having violations of trust, deficit, fraud, or improper conduct. How is the Investor Compensation Fund funded? Initially, it was funded by the SFC. Afterwards, when we trade stocks or futures, a fee called the Investor Compensation Fund levy is collected. Whether you are a buyer or a seller, you must pay the fee according to a specified rate. Now let me test you. If a client invests on their own and makes a loss in the stock market, can they apply for the Investor Compensation Fund? No, they cannot, because the investment loss is not caused by the intermediary, but by their own investment failure. However, if the intermediary does not follow your instructions, causing you to lose money or miss out on potential earnings, then you can apply for the Investor Compensation Fund. If an investor unfortunately suffers losses caused by the intermediary, can they claim the full amount from the Investor Compensation Fund? Remember, there is a limit to the Investor Compensation Fund. A claimant, who can be an individual or a company, can receive up to 500,000 Hong Kong dollars in compensation. If you invest in securities, you can get a maximum of 500,000 Hong Kong dollars in compensation. If you invest in futures, the maximum compensation amount is also 500,000 Hong Kong dollars. This compensation limit is calculated per claimant. In other words, if you and your spouse open a joint account to buy securities and suffer investment losses, both of you can receive up to 500,000 Hong Kong dollars in compensation each. Keep in mind that these investment losses must be from products traded in the SEC, the Stock Exchange of Hong Kong Limited, or HKFE, Hong Kong Futures Exchange, to be eligible for compensation claims. Let me test your understanding with two questions. First, if an investor buys securities and futures from the same intermediary and suffers losses in both, what is the maximum compensation they can receive? The maximum compensation for securities is 500,000 Hong Kong dollars, and the maximum for futures is also 500,000 Hong Kong dollars. Since there are losses on both sides, the total compensation amount is 1 million Hong Kong dollars. Second, if an investor buys two types of securities from the same intermediary with separate securities accounts and unfortunately suffers losses, what is the maximum compensation they can receive? The maximum compensation for securities is 500,000 Hong Kong dollars. Although the investor has two securities accounts, they can only receive a maximum of 500,000 Hong Kong dollars in compensation. The Investor Compensation Company Limited is established by the SFC, Securities and Futures Commission, and is a wholly owned subsidiary of the SFC. It is mainly responsible for the operation of the Investor Compensation Fund and handling claims made against the fund. In simple terms, it is an institution dedicated to receiving, reviewing applications for the Investor Compensation Fund, and disbursing compensation amounts to claimants. Well, as mentioned before, listed companies have an obligation to disclose inside information to the public so that they can make informed investment decisions. This is also called disclosure of interests. It's like using a dating app to find a girlfriend, telling people whether you are male or female, a doctor or an insurance agent, driving a car or taking a bus, so they can know your situation and decide whether or not to say hi and become friends. The SFO, Securities and Futures Ordinance, also states that when a listed company becomes aware of inside information, it must fulfill its responsibility to disclose the inside information and do so as soon as possible to the public. Where should the inside information be disclosed? First, it must be published in newspapers. Second, it must be posted on the HKSI e-submission system as a listed company announcement. What is inside information? Remember, inside information must be very important information. This inside information can significantly affect stock prices and is unknown to the public. For example, I know that Vita will stop producing lemon tea and start producing soy milk tomorrow. This decision may have a significant impact on Vita's stock price, but the public is not currently aware of this information. Is this considered inside information? It is inside information. On the other hand, if I know that Vita's truck broke down yesterday and no one else knows about it, is it important? No, it cannot affect the stock price, so it is not considered inside information. Where does inside information come from? Remember, inside information must come from officers, major shareholders, etc., of listed corporations, and may also come from professionals such as lawyers, accountants, or main trading counterparts. If I happen to see a Vita's order stating that they will stop producing soya milk starting tomorrow, this information does not come from the aforementioned people, so it is not considered inside information. When is a listed corporation considered to be aware of inside information? When senior management of the corporation, such as directors and managers, become aware of information that has a significant impact on the company's stock price while performing their duties. For example, the director of Vita decides to stop selling soy milk and start selling siumai instead. The director is already aware of the information, and it is enough to affect the stock price. In this situation, we would consider the listed corporation is already aware of this inside information. In some situations, listed companies do not need to disclose inside information. For example, if a court issues a protective order that prevents the listed company from disclosing certain confidential information, or if the inside information concerns an incomplete proposal or negotiation, there is no need to disclose it to the public. For example, if Vita plans to acquire a dim sum company in the future and launch dim sum products, it is only a plan and not yet formally implemented, so there may be no need to disclose it to the public. However, if Vitasoy has already acquired the dim sum company and completed the transaction, they must disclose this information to the public. If a listed corporation violates disclosure requirements, the officers of the corporation may be held accountable. Under what circumstances do officers have to bear legal consequences? If the officers deliberately fail to act or are negligent in forgetting to act, resulting in the listed corporation not complying with the disclosure requirements, they have committed a violation. In addition, if the officer fails to take reasonable measures to prevent the breach, they will also face legal consequences. What are the legal consequences? The listed corporation, or its directors, must bear legal consequences in the Market Misconduct Tribunal, which may include fines. Failure to comply with disclosure requirements may lead to financial losses for investors. As a result, these victims may demand that the listed corporation and its directors bear civil consequences and provide appropriate compensation. Remember, the SFO, Securities and Futures Ordinance, requires listed companies to disclose information about their equity, which means disclosing who holds how many shares in the listed company, in other words, how many voting rights they have. Regardless of whether the shares involved have been issued, you still need to disclose this information. Are there any rules concerning the duty to disclose interests? First, the directors and chief executives of the listed company must disclose all interests. In other words, no matter how small the interest they hold, for example, only 0.1%, they still need to disclose it. Second, if a general investor holds at least 5% of the listed company's shares, they must disclose their shareholding. In contrast, if their shareholding is below 5%, they don't need to disclose it. Now let me test you. If a director of a listed company holds 4% shares, does he need to disclose it? The answer is yes, he must disclose all interests. All right, what if an ordinary investor holds 0.2% shares? Do they need to disclose it? No, they don't, because disclosure is only required when reaching 5%. So what constitutes an interest in the relevant share capital of a listed company? It includes convertible bonds, preferred shares, warrants, options, and even long and short positions that you hold. Anything related to the shareholdings of the company needs to be included. In addition, if you have attributed interests, such as corporate shareholdings, trust arrangements, or family arrangements, these are all part of the interest in the relevant share capital and need to be included in the calculations and disclosure. If you have already fulfilled your disclosure requirements, but there have been changes to the equity you hold afterwards, then you need to disclose the changes. If you originally held a 5% equity stake, but you sold all of your shares and now hold less than 1% equity, in this situation, the percentage level of your interest has changed. Whether it has increased or decreased, you need to disclose the change. Additionally, if your equity interest changes from one type of derivatives to another, you must disclose the change again. For example, if you initially held convertible bonds and decided to use them to convert into shares, your interest would change from bonds to shares, and you would need to disclose this change again. In summary, as long as you are a person with disclosure requirements, such as a director, when there are changes to the equity you hold, including changes in the percentage level or nature of the interest, you need to disclose the changes so that the company and other investors are aware of them. How and when should the disclosure be made? Generally speaking, if there is a change in equity interest, disclosure should be made within 3 business days. The HKEX, Hong Kong Exchanges and Clearing, has a website called HKEX News, which has an online disclosure system. You can submit relevant documents electronically to complete the disclosure process. Once you have submitted the documents, HKEX will publish them on its website for public review. If you fail to follow this procedure, it is considered an offense. You might think that it's troublesome to disclose everything. In fact, the SFO, Securities and Futures Ordinance, does provide some exemptions. If the information is not helpful to the SFC, Securities and Futures Commission's regulatory activities, there is no need to disclose it. This way, everyone can save some energy and rest, and at the same time make more money. The SFC, Securities and Futures Commission, can investigate anyone, so they can check who the shareholders are and which listed company they belong to. Apart from the SFC, are there any other individuals who can investigate listed corporations' shareholders and their equity interests? Remember, a listed corporation itself can also initiate an investigation. The listed corporation can request persons holding voting shares to confirm specified information. When members holding at least 10% of the total number of issued voting shares of a listed corporation, they can require the corporation to conduct such an investigation. For example, I hold 10% of Vitasoy's shares, and I want to know who holds the remaining 90% of shares, then I can require the company to investigate. After the listed corporation completes the investigation and obtains the information, there are several things to do. First, notify the stock exchange and the SFC. The listed company must provide the information on shareholder identity and interests to the stock exchange and the SFC. According to regulations, the stock exchange needs to publish the relevant information. Note that if the listed corporation is an authorized financial institution, it must also notify the HKMA, Hong Kong Monetary Authority. Second, if a shareholder requests an investigation, the listed company must also prepare a report made available to its members. In other words, the company should submit the results of the investigation to the shareholder, allowing them to see what has been done and what has been found. Apart from the SFC, Securities and Futures Commission, and the listed corporation itself, the Financial Secretary also has the authority to investigate the identity and interests of listed corporation shareholders. If the Financial Secretary deems it necessary to know who truly controls the listed corporation, or if they receive an investigation request from a member of the listed corporation, the Financial Secretary can appoint an inspector to conduct the investigation, thereby confirming the identity and interests of the listed corporation shareholders. The SFO, Securities and Futures Ordinance, also includes miscellaneous and additional provisions, including secrecy provisions, specify various persons to whom the SFC, Securities and Futures Commission, may provide confidential information, and statutory immunity is provided to persons performing the SFC statutory functions in good faith, or auditors reporting suspected fraud and other improper practices they encounter in the course of their audits are given immunity from civil liability. If anyone knowingly provides false, misleading, or disruptive information to the SFC, Securities and Futures Commission under the circumstances where the key information is false or misleading, it constitutes an offense. This provision also applies to the disclosure of listed corporations. If a listed corporation provides false or misleading information, it also constitutes an offense. As long as the court approves, the SFC, Securities and Futures Commission, can intervene in civil proceedings, but it must involve cases related to the SFO, Securities and Futures Ordinance, or certain parts of the CO, Companies Ordinance. When the SFC deals with civil proceedings, it can choose to handle it on its own or proceed through a solicitor. If a corporation commits an offense, do the officers of the corporation, including directors, company secretaries, and senior management, need to bear legal responsibility for the corporation's criminal acts? The answer is yes. Since officers have the power to control and manage the company, they can influence the company's decisions and have the ability to prevent improper actions. If an offense under the SFO committed by a corporation is aided or abetted by, counseled or procured by, or committed with the consent of, or is attributable to the recklessness of, an officer of the corporation, that officer will be guilty of the offense and be punishable accordingly. So, if anyone knowingly, recklessly, or negligently issues a false or misleading communication to the public, and this information could affect the price of securities and futures, this is an offense and requires taking legal responsibility, usually compensation. In other words, making a false or misleading public communication about securities and futures contracts entails civil liability. Remember, within Hong Kong's framework, who has the authority to decide what products are securities, what are futures, and what are collective investment schemes? The Financial Secretary has the power to determine the classification of these products and capture new products in the regulatory net. Additionally, the Financial Secretary also sets out documents to determine whether a financial product is considered an OTC, over-the-counter derivative product. As for the formulation of rules, codes, or guidelines, the responsibility mainly lies with the SFC, Securities and Futures Commission.